these cash flows, and later on we look for the net present value. And if our NPV is positive, we shall accept. If it is negative, then we reject. Now, remember I say that in year 0, that is when you invest the initial outlay. You invest in year 0, and then you begin getting returns at the end of period 1. So our initial investment is 200 million. Okay. So if I discount this at 10%, discount factor at 10%. So I need to go to my tables, present value tables, and I look for those discount factors. And for period 0, of course, it is 1. Okay. And then I will be getting those discount factors multiplied by the cash flows, so that I get the present value, PV. Okay. And for year 0, 200 million, of course, is a cash outflow because you are spending. And then if I get 200 million times 1, of course, the present value will be 200 million. Okay. Now, I need to go to the tables. And the tables, I believe you have them, because I say that you can download these tables. You can download them on the website. So if I get let me just share the tables, and then anybody with tables, so that you give me those rates?
Year 1 is 0.09.
Year 1?
0.0991.
Just a moment. Year 1, it is 0.
0.901. 0.9091.
Then year 2?
Year 2 is 0.8264.
Then year 3?
0.7513.
Year 4?
0.6830.
0.6830. Year 5?
Year 5 is 0.6209.
6209. So now, when you multiply discount factors with the cash flows, what would be the PV? $40 million times 0.9. 091.
That is 36 million.
364.
360.
Okay. Then here, 60 times 0.8264, 49.584. Then this one, times 80.
That is 60.104.
104. Then this,
that is 34.150.
then this,
$43.
43.463.
So having done our PVs, we can now get our NPV. So my NPV is going to be the sum of all the PVs. So my NPV, so you need to sum up these ones, eh? And remember, this first one is an outflow. It's a cash outflow. So what is the NPV? The NPV is what?
Again, PV is 23.665.
Positive or negative?
Positive
23.665.
665.
That is my NPV. And it is positive. You remember the decision rule was that if the NPV is positive, you accept the project, because that means that the project will be able to yield a return which is higher than the required rate of return, in this case 10%. So in this case, we accept. Assuming it was negative, then we'll reject. So that means that that project will not be able to generate the required rate of return. So that is what you need to note. Okay. If it is positive, accept. If it is negative, reject. Okay. Now, of course, this technique has got a number of advantages and disadvantages. And one of the advantages for this technique is that it considers time value of money. Okay. We looked at time value of money at the beginning, because this technique discounts the cash inflows to their present worth, as we've done here. Okay. Discounts the cash inflows to their present worth, of course, using an appropriate discount rate. Then it considers all the cash flows of the project over the entire life of the project. And this is normally the overall objective of any firm, because the objective is to maximize the wealth of the investors. Okay. So meaning that any decision that is undertaken using this technique, of course, enables the firm to meet the overall objective. Okay. Then it is a unique method, because you may not have You cannot have one single investment having more than one value of NPV. So meaning that it is a clear method to use, especially if you are evaluating estimates. But also, the method may have some disadvantages. One disadvantage is that it may involve some complex calculations, which may not be easy to understand by managers, especially those that do not have formal background of quantitative techniques. Because you may find that, by the way, the cash flows may not be given. Maybe you have to determine the cash flows. So when it involves determining the firm's cash flows, then it becomes a little bit complicated, especially if you are to generate those cash flows, in other words, to use in evaluating the project. Okay. Then also it may be difficult to use where you find that the project cash flows that be forecasted over a long period of time. Okay. Then also not applicable or not actually employed, especially in a small business environment. And it may also be of limited use where you have benefits or costs, okay, that may be non-quantifiable. Then also another disadvantage is that this technique assumes that firms, organizations pursue the objective of maximizing the wealth of their shareholders. But of course, in most cases, you find that it may not apply, given that in any organization, you may have different stakeholders, and you find that each of the stakeholder has got his or her own vested interest in the organization. So meaning that using this technique, of course, it may be of limited use since it assumes that the major objective of the firm is to maximize wealth of shareholders. Yet in any organization, you find there are different stakeholders, and each stakeholder has got his or her own objective or interests within the organization. Okay, so that is net present value. Of course, as one of, because remember from the beginning, we say that we have methods that consider time value of money, and then those that do not consider time value of money. And NPV is one of the discounted cash flow techniques. Okay, now another method is the internal rate of return, IRR. IRR, or internal rate of return. And the internal rate of return, that is the required rate of return that is that an investor must earn. And this required rate of return equates the PV of cash inflows to the PV of cash outflows. When I talk of PV, that is present value. Okay, the present value of cash inflows equal to the present value of cash outflows, so that the NPV is equal to 0. Okay? So now, computing the IRR, of course, we have to select two discount rates. And of course, one discount factor or discount rate should give us a negative NPV and another one a positive NPV. And using linear interpolation method, we can be able to determine our internal rate of return, okay? And for us to get the IRR, we need to get a % plus, open the bracket, P divided by P minus N into B minus A. And these variables are described here, where A is the discount rate that yields a positive NPV. Then B is a discount rate yields a negative NPV, and P is the positive NPV, and N is a negative NPV. Okay. Of course, when we come here, because this is P minus minus, so meaning that our formula will change here. The minus minus, that would be positive. So meaning that here it would be P plus N. Okay. Would be P plus N. Now, there is an example here. They are saying that a firm wishes to invest 100 million in a certain venture where it expects for the 2 million cash flows to be earned per annum over the 3-year life of the venture. They are saying that we compute the IRR for the project at a discount rate of 12%. Now, the initial investment is 100 M. Then you expect to receive cash flows of 42 for 3 years for the 2 million. And this is an annuity because the cash flow stream is uniform. So the cash flow stream being uniform, I may not do it the other wrong way. Okay. My layout now will change. I have year 0. And year 0, that's when I invest. Initial investment. And initial investment is 100 million, and it is an outflow. Okay. 100 M. Then from year 1, 3, I expect to receive the cash inflows, the returns will be 42. 42M. Now, if I discount these figures, discount factor at 12%. For year 0, of course, it is 1. It is 1. In the PV, here, is what? 100M. Now, I need to go to my tables, annuity tables. Now, this time I will not use present value, but I will use present value of an annuity. Okay, so who can get the tables, rather the discount factor? Here, 12% 3-year annuity.
It's 2.402.
2.402.
Yes.
So when you multiply, what do you get?
Get 100.
100.
0.884.
Point
884.
884.
Exactly.
So meaning that my NPV in this case what is the NPV? What is the NPV? NPV?
I think our NPV will be 0.884. 0.884.
884. And when you look at
Yes.
this, is it positive? Yes. This is a
It's
positive
positive.
NPV. Okay. Now, you have seen that 12% has given me a positive NPV. Now, I need that rate.
Excuse me.
Yes.
Now, this takes me back to the previous number which we calculated, because the figure we took for NPV, I think the person who calculated didn't consider the initial investment of 200, which makes me believe that the NPV should be 23.665, not 200 to 223.665.
Well, this is 23.665. That's what I have.
I think I'm the one who had taken a wrong figure then. Okay, thank you.
So now you have seen that this one has given me 12% has given me a positive NPV. But then I want that negative NPV, that discount rate that will yield a negative NPV. Okay. And of course, I'm going to estimate. I will estimate. And if 12 has given me a positive, okay, so that means that if I increase my rate further, it may give me a negative NPV. Now,
excuse me, sir.
yes.
I thought the NPV is an addition of the PV. So
Yes.
how have you got 0.884?
If I have 100, because this is inflow and this is outflow, 100.884. You subtract 100.
Okay.
Because when you add these two, remember one is a negative. So the net.
Okay, I get it now. Yeah.
Because the initial investment is always a negative. It's an outflow. Now, I need to estimate the rate which will yield for me a negative NPV. And since 12% has given me a positive, okay, by increasing this rate further, I will be able to get my negative NPV. And just go to your tables and look for the highest. Don't look for a rate that is close to 12. Because you may find that you look maybe for 14, you compute, it gives you still a positive NPV. There you will be wasting time. You increase the rate, actually take the highest, because at the end of it all of you will have the same internal rate of return. Okay? Now, I may say I'm going to use, let's say, 20% using the discount factor of 20%. So you can take this. So this is 20%. So of course for year 0 it is 1. Then year 1, 3. Now I need to look for the 3-year annuity. At 20%. What do you get?
It is 2.1065.
The other one was what? The other one was 2.4. So this one is going to be 2.1065. So when you multiply by 42, what do you get? Mm-hmm.
It's 88.473.
88.473.
Yes.
Now, you realize that now the initial outlay is higher than the returns. So meaning that in this case, my NPV would be what?
Negative 11.527.
11.257, and it is negative.
11.27.
Hmm? 527.
Yes.
Now, I have got my negative, I've got my positive NPV. And then the negative. Now, using this formula here, Okay. Now, my A, what did I say A is? The discount rate that yields a positive NPV, and that is 12%. So this is 12%. Then P is that positive NPV. The positive NPV was 0.884. 0.884. Okay. Then P still is that positive NPV, which is 0.884. Then minus a negative NPV, which is 11.527. Then into B minus A, and B is that discount rate associated with a negative NPV, which is 20%. Okay. Then minus 12%. Okay. So if I simplify this further, this is going to be 0.12. This is going to be 0.884. Now, you see, this is 0.88 minus. So that means now this is going to change into a plus. Because a minus, a negative minus a negative. So it's going to be 0. What? It's going to be 0.884. I add 11.527. Okay. Then into 0.2, so 20%, that is 0.2 minus 0.12. So what do you get then? So my IRR is equal to
12.5698.
12.5698.
5698.
Round off the nearest.
Becomes 12.57.
12.57.
Yes.
So 12.6%.
Correct.
So that is my internal rate of return. Now, I've computed my IRR. So now this IRR, of course, computing the IRR, the internal rate of return, you need to compare it with the required rate of return by the investors. In this case, assuming that we had been given the required rate of return, then we would compare this internal rate of return and we see whether it is above the internal rate of return by, rather the required rate of return. Assuming the RRR, the required rate of return by investors, was 10%, okay? assume that the required rate of return by investors was 10%, then in this case, would accept. But if it was above, maybe 15, then we would reject. Okay, so the internal rate of return will have to be compared with the required rate of return by the investors. If you find that your IRR is greater than the required rate of return, then you accept, because that means the project is viable. It is going to generate a return which is higher than the required rate of return by the investors. So the investor always acceptance rule is that the investor always sets a minimum required rate of return on the investment. So if you find that the IRR is greater or equal to RRR, the project is accepted, because such project would have a positive NPV and value to the worth of the farm. But if the IRR is lower than the triple R by the investor, in that case, the NPV would be negative. Such investment would actually reduce the farm's worth. So in that case, you need to reject. Okay. And I've noted here that the required rate of return by the investor represents the minimum required rate of return that should be earned if you are to justify the commitment of funds into any given what? Investment. Of course, the advantages and disadvantages. Advantage one, considers time value of money, considers the cash flows of the project over the life of the project, and may also be easier to understand, by the way, compared maybe to NPV. Okay. Then another the disadvantage is a relative measure of worth, and eventually this could be misleading to the investor. Take an example, you have two investments, A and B. You find that A has NPV of 50 million. Then investment B has NPV of 10. So meaning that the IRR here for A is 10% and then B is 25%. So what does it imply? That investment B has got a higher rate of return than investment A. But when you look at it in terms of real contribution to the wealth of the investor, you find that A is better than what? Is better than B, because you find that A has got a larger NPV, meaning the higher, the greater the NPV, okay, that means the more you increase the wealth of the investors. But if you base your decision on the internal rate of return, you would end up going for investment B, yet investment B does not in any way, okay, it increases the wealth of the shareholders, but of course not at the level of investment what? A. So meaning that IRR could be misleading, okay? Could be misleading. So that is internal rate of return, IRR. So I think you've got the internal rate of return. So what you need to know is that
I have a question.
yes. Uh-huh.
The example we've just
Mm.
we started with we had a discount. We had a discount rate of 12%.
Mm.
So then I'm wondering, how did the 20% come in?
I said you need to estimate the rate that would give you a negative NPV. So if 12 has given you a positive, so that means estimate that rate, you need to increase the rate further. And I say that take the highest, because if somebody takes also 25, you will still come back to the same, get the same internal rate of return. Assuming somebody had used the 25, still you will get the same IRR. As
So
long
does
as
it mean this?
you have a positive and negative NPV, and as I said, you use the linear interpolation, so you still get the same internal rate of return.
So basically, the discount rate assumed is based on the individual, so that you come up with a negative, and then you'll be able to substitute in the formula that we have.
Yes, you need to look at the rate. If the rate that they have given you has given you a negative, a positive NPV, okay, then that means that you need to increase the rate further. We have said that take the highest, because if you choose a rate which is gross, straight, you may end up getting
another positive
NPV, and you'll be wasting a lot of time, because now you would have taken time to go through those computations, and then you find that it has given you a positive again, and then you have to do again. Find time is running and you're chasing time. So ensure that if the rate given has given you a positive, because at least they will give you one rate. One rate will be given. Then it's you to estimate the rate that will give you the NPV that you require.
Okay.
Now, and of course, I've said that the acceptance rejection criteria, once you compute your internal rate of return, compare it with what the investors require. If you find that your internal rate of return is higher than what the investors require, then you accept. If it is the other way around, then you reject. So that is another method. Then the third method, which considers time value of money, is profitability index, PI. Okay? Profitability index. And with PI, it is the ratio of present value of cash inflows to the present value of outflows. So in other words, you are looking at the cost benefit ratio. And how do you get the PI? For you to get the PI, you need to get the present value of cash inflows divided by present value of cash outflows or initial outlay. So an investment which has a PI greater than 1 would increase the wealth of the firm. Okay? Because that means that you'll be able to generate a positive NPV. It is easier to generate a positive NPV as long as the PI is greater than 1. And you may find that you may have projects, 5 projects, and maybe you find that all the projects have got a PI which is greater than 1. So meaning that if they are all greater than 1, then you're going to rank them and see which of the projects gives you a higher PI. So meaning that you will rank them according to the profitability index. The one with the higher PI would be given priority. So that means that if it is giving you a higher PI, it would be easier to generate a positive NPV that would increase the wealth of shareholders. Okay, and the acceptance rule is that an investment is accepted if its profitability index exceeds 1, and it is rejected if it is less than 1. Okay, and the acceptance or rejection criteria give signals consistent with those of IRR and NPV. Now, let me just get a simple example for PI. I'm trying to get an example. Okay, now this is the example which I'm putting. They are saying that MK company has 100,000 available for investment, and it has identified the following 5 investments in which to invest. All investments must be started now. That is in year 0. So you have projects A, C, D, E, F, and G. Then you have initial investment in years 0, and then you have the NPV for each of the projects. They are saying that determine which project should be chosen to maximize the return of the business. Using PI, let me add, using PI, using profitability index. Determine which project should be selected to maximize the return on the business. Okay, so in this case, by the way, they are saying that all the investments must be started now in year 0. Now, what I need to do is that I need to determine the PI of each of the projects. So if I determine the PI, the profitability index, PI for each of the projects. So what did I say to get the PI? I need to get the PV, present value of cash inflows, divided by present value of cash outflows, or initial outlay. So meaning that for project C, it's going to be 20 divided by 40. So that gives me what? 20 divided by 40.
0.5.
0.5.
0.5. Then for project D, 35 divided by 100, 0.35. Then 24 divided by 50, 0.48. Then 18 divided by 60, 0.3. Okay. Now, of course, this one is out. Project TG is out. Why is it out? Why am I excluding project G?
Because it's below 1.
No, because you can see that all these projects, their PIs are less than 1.
Because it is a negative.
Yes, because it has got a negative NPV. So ideally, since project G has a negative NPV, that means you don't even need to waste time on it, because it will not generate a return that is higher, or that is going to maximize the wealth of the shareholders. Now, when you look at all these projects, you realize that they also have a PI of less than 1. Because what did we say? An investment that has a PI that is greater than 1 would increase the wealth of the firm. But now you realize that all these less than 1. But still we can, basing on this, I can rank the projects basing on their PIs much as they are less than 1. I can rank them. So if I rank these projects, if I give them a rank, the one with a higher PI will take the first rank. So that means this is going to take the first rank, and this one will take the second, this one will take the third, and then this one will take the fourth. Okay. And as I undertake them, of course, I also need to consider the available funds. So meaning that if I am undertaking these projects, the projects that I will undertake, the projects to be undertaken, the first round, the one that's of course the first one is going to be project C. And project C requires an initial investment. So the outlay, the initial investment, what is 40. Okay. And then the NPV earned is 20. Then I go to the one of second. Second is project what? Project E. And it requires an initial investment of 50. The NPV earned under this 24. Then I go to the project that requires the one of third. Now, third is project D. But remember my available funds. Yes, only 100,000. Available funds is 100,000. So when you check the funds, what have I used so far?
$900.
Yes. I've used 90,000. So what is remaining? So that means project D. I will only take a pass, just a small portion of it. It requires 100, but I only have 10,000. Because remember the maximum amount available is 100. So that means I've taken a portion, I've allocated a small percentage, project D. Now, when I look at the NPV earned, so the NPV and would be what percentage? Because now, remember project D, I have only allocated 10 out of the required 100. So what percentage is that?
10%.
10%. The NPV and for this project would be 10%. 10% of what? Project D, its NPV is 35. Okay. So that means that the NPV I have earned 10% of 35. That is
3.5.
3.5. So that is how I'm going to select the projects. Okay. And the total NPV earned would be 20 plus 24 plus 3.5. That gives me 47.5. So that is that is how I'm going to select the projects. And of course, the above selection would maximize the return to the business. Of course, using profitability index. Okay. I think that one is okay. Any issue on the PI?
It's just that my network went off and I missed some of the things that were discussed here. So I was just trying to follow. And I've actually also sent you a message. I don't know if you've seen it. It's a direct message that I've just posted in the chat.
You want the recordings, eh?
Yeah, because one of the challenges of internet is sometimes now, like with this particular challenge I just got, I don't know what happened. I had to borrow my wife's internet to try and tether with this laptop. So, and so by the time I came back, I'd missed quite a number of things there. So, which I want to believe happens with most of us. And sometimes you want that continuity, which you lack. But if maybe we had these videos, somehow you would try to follow.
Okay, let me see how I can share those. You know, the challenge is you need to first upload them. But anyway, I will see what to do in the coming week. They will be available in the coming week. All right. So we have looked at the three methods now. Those that incorporate time value of money. Then we also looked at those that do not consider time value of money. So having looked at that, now we need to bring in the element of risk and uncertainty. Because you see, all this that we are doing, you find that you are basing on forecasts. Okay? And these forecasts sometimes are subject to uncertainty. Now, like there is COVID, nobody knew that there was going to be COVID. You could have maybe planned to do something, and you made your projections, but you find that maybe what you had projected, you've not been able to realize it because of COVID. Okay, so the question is, since now we are saying that these forecasts that we always make, or the projections that we always make, may be subject to risk and uncertainty. So how do we handle the two? How do we incorporate risk and uncertainty within our projections that we make? And we need to identify these two because the two are not the same. When we talk of risk, it is different from uncertainty. Because with risk, you can quantify it. Okay? You can measure, you can assess. Okay? In other words, you can attach probabilities, associated probabilities, and you use some mathematical models or techniques, okay, to measure that and be able to put in place measures to mitigate the risk. But for uncertainty, it is a little bit different. Because the outcomes, you cannot mathematically model them. Okay? And of course, there are different ways of how you can incorporate the two. Okay? Because you find that there is concern as regards to the accuracy in estimating maybe the life of the project, also the cash flows that you are expecting to get, and even maybe the discount rate used, because you may find that maybe you are using the cost of capital. But this varies depending on the economic conditions. Because you may find that maybe the finance providers may increase the rates, or they may lower the rates depending on the prevailing economic conditions. Okay. Now, how do you incorporate uncertainty in investment uprising? Of course, there are different ways. Number one, you can set a minimum payback period. So any project that does not meet that period, payback period, then it doesn't qualify. You can also make prudent estimates of cash flows. Okay. So meaning that as you're estimating, you need to exercise a high degree of caution. Okay. Then assess both the best and worst possible situations. And then you can also use sensitivity analysis, which we're going to look at now. Then incorporating risk, you can use expected values. You can use simulation models, discounted payback, and then you can also use the risk adjusted discount rates or certainty equivalent approach. Now, sensitivity analysis. Now, when you talk of sensitivity analysis, we are looking at posing what if what you are planning does not happen. What if, for example, the demand for our products has fallen by maybe a certain percentage compared to what we had originally forecasted? What would happen? Would our project still be viable? What if our selling price has fallen? What would happen? What if our cost of capital has increased? what would happen? Would the project still be viable? So we are looking at the sensitivity of the given variables on the decision that we have undertaken. Now, like the way we're evaluating those cash flows up there, looking at the cash flows, looking at the discount factor, okay? So we are looking at how sensitive are those variables to our decision in case there is a change. And this change could either be upwards or downwards. Okay. So, and for us, calculate the sensitivity. Okay. We need to get the NPV of the project, and we divide by the present value of the cash flow under consideration. Okay. The present value of cash flows of all these other variables that we are looking at. It could be selling price, it could be cost of capital, it could be the time period, the life of the project, etc. And the lower the sensitivity margin, the more sensitive the decision, the particular parameter that is being considered. So if you find that you have a low sensitivity margin, like for example, you're looking at the sensitivity to maybe selling price, and you find that it is very low, so that means that any slight change in prices would change your decision, either from accept to reject. Okay. So now, if you're computing the sensitivity, you need to follow the tabular approach, the layout for the NPV calculation, since we need the PV of each cash flow. So meaning that you need to follow this, have your period, have your cash flow, discount factor, and then look at the PV. Now, like we have an example here. They're saying that an investment of 40,000 today is expected to give annual contribution of 25,000 and annual fixed costs of 10,000 for the next 4 years. And the discount rate is 10%. They're saying we calculate the NPV of this investment. So this one is very okay, because at least we have looked at how to compute NPV. Now for me to compute the NPV of this investment, we can, the period, I have period 0. This is where I have the initial outlay, and initial outlay in this case is 40,000. And of course it is in bracket because it is a cash outflow. And the discount factor at 10%, we say that the discount factor for period 0 is 1. So meaning that the PV for this case is going to be 40,000. Then I go and look at the returns now. I have annual contribution. So I have from period 1 to period 4. Because now since the cash flow stream is uniform, I will use annuity. So I have annual contribution of 25, and it is an inflow. Okay. So Go to the tables. Look for the 4-year annuity at 10%.
3.170.
3.170.
3.170.
Yes. So when you multiply, what would be the PV of annual contribution? The divide times 3.170.
79,250.
79,250, and it is an inflow. Then I go to annual fixed costs. Year 1 to 4, I have annual fixed costs. And the amount is 10,000. But I also need to get the PV. The discount factor 4-year annuity at 10%, we've said it is 3.170. So that gives me, and remember the fixed cost in bracket, because it is an outflow. So that gives me
31,700.
31,700.
700.
And it is in bracket. So I think those are the only, if I had variable also, but I don't have variable costs. Now, summing up the PVs of each of these cash flows, of course, I would get my NPV. So what would be my NPV? My NPV,
That is 7,550. 7,550.
inflow, rather positive or negative? Is it positive NPV?
Yes, yes. Positive. Yeah, it is positive NPV.
Are you sure? It's positive. Okay. Now, by looking at this, the project is viable. This investment is viable because it has a positive NPV, meaning that it will generate a return which is higher than the cost of capital. And of course, the discount rate is 10%. But then B, they're saying, how sensitive? What is the sensitivity of your calculation to the following initial investment? How sensitive? Is the initial investment? Okay. Now, and I say that for us to get the sensitivity, to determine the sensitivity. Now let me look at the initial investment. How sensitive is the initial investment? So I need to get the initial investment, to get the NPV, which I've computed above, as 7,550. I divide by the present value of the cash flow that we are considering. And now we are considering initial investment, which is 40. So I divide by 40,000, then I multiply by 100 so that I look at the sensitivity. So how sensitive? What is the percentage? What percentage?
18.9.
18.9%. So what does it imply? The implication is that if the initial investment, so you can see Boaz has put up the hand. Yes, Boaz.
Yes, good morning, sir.
Yes, morning.
So what I wanted to find out, you consider the absolute, you disregard the whether it's a negative or positive when you come to PV.
I may leave out the negatives.
Okay.
So I can
Thank you.
conclude by saying that if the initial investment, because actually you can see that we say that the lower the sensitivity margin, the more sensitive that given parameter that you are considering. But now you see it is 18%, which is a little bit high. It's not too low. Because for something to change by 18%, really, so many conditions must come into play. So if the initial investment increases by 18.9%, in other words, you find that your project requires an increase in the initial investment by this percentage, then the project decision would change from accept to I think my network had gone off. So that is the challenge of Lika Mobile. So what I was saying, I don't know whether you're able to get me now. Are you able to get me?
Yes,
Yes,
now
I
we
can.
Yes. So I was saying, if the other variables, like annual contribution has remained at 25, and annual fixed costs have also remained at 10, and our initial investment increases by 18, you find that you have to increase the investment. Your project requires an increase in the initial investment by 18.9. So that means that your decision will change. Now, let's do it and we'll see. Assuming we increase this 40,000 by 18.9%. So what would be, so if I get 18.9 times 40, the increment would be what? 7,560. So the total here would be 47. Let's put now 47,560. Okay. I want to see whether it will change. Now here it is 47. $560. So what will be so what will you have? What would be the NPV in this case?
Negative 10.
Huh? Negative?
Negative 10.
Negative 10. So you see what I was telling you? That should the initial investment increase by 18.9%, then your decision is going to change. The project will no longer be viable, especially if you find that the annual contribution has remained the same. So ideally, if the initial investment increases, then you would, if you want still really to maintain this project, then your annual contribution should also be increasing. But should you increase the initial investment and then you find that the annual contribution has remained the same and the fixed costs have also remained the same, then that means that your decision is going to change. The project will no longer be viable. So that is how sensitive the initial investment is to our decision above. So in other words, you must ensure that it does not go beyond 18.9. Should it go beyond that, or should it increase by 18.9? Then that means that your initial your decision will do what? Will change. Okay. Now let's look at the sensitivity. The sensitivity to contribution. So sensitivity to contribution. So I need to get the NPV, which is 7,550. I divide by the PV of the cash flow under consideration. So this time I'm considering annual contribution, which is 79,250. So I divide this by 79,250. Then I multiply by 100. So what do I get? What is the rate?
9.5.
9 point. You see now you see this one is a little bit close. Okay. So now what is the conclusion? The conclusion for this is that if the annual contribution decreases, not increasing this time, decreases by 9.5%, the project decision will change. Okay, the project decision will change from accept to reject, assuming the other variables are constant. Should the annual contribution decrease by this and the other variables remain constant, okay, the decision will change from accept to reject. The project will you will no longer have a positive NPV. That is how sensitive the contribution is. The sensitivity of annual contribution is at 9.5%. Because remember, with sensitivity analysis, we are looking at how sensitive are these variables to the decision, to the NPV above that we have calculated. So you can see 9.5 for contribution. So NS right 4 of the annual contribution by 9.5. That means it is going to change the decision. Then we look at fixed costs. Fixed costs, NPV is 7550 divided by the PV of the cash flow under consideration, and fixed cost is 31,700. 31,700. So multiply by 100. So what do you have? What is the sensitivity?
23.8.
23.8. So you see, this one is a little bit high. So now, in other words, if I'm to look at for the parameters that I've already considered, I can see that the variable that is more sensitive now is contribution. NS right 4, your decision will change. Okay? Because now I can see from what I've computed out of these 3 parameters, contribution is more sensitive. NS right 4 will change your decision, followed by initial investment. NS right increase. So this is 23 point. So what would be the conclusion? The conclusion, who can conclude? Can you conclude on this? Give me the, what is your take? If the fixed costs, do what? If the fixed costs increase by 23.3%, the project decision will change from accept to reject. So you can see that the fixed costs, they are not actually all that more sensitive. Okay, because you see the percentage. Because remember, we say that the lower the sensitivity margin, the more sensitive that parameter is. Now, discount rate. How sensitive is the discount rate? Okay. And now for us to get the sensitivity of the discount rate, we assume now that we don't know the discount rate. Okay. And of course, for us to determine or get the discount rate, we need to look at that discount factor that gives us an NPV that is equal to 0. Okay, so in other words, if I have here 0, I have the initial investment. As 40,000. Okay, but I don't know the discount factor. Discount factor, this one I don't know, but I need the PV. Okay, But for year 0, it is known. For year 0, it is 1. So the PV here is 40. Then the NPV, of course, now I have here 1, 4. The initial investment, the cash flow, the returns, the net contribution. Net contribution is 15. Because I have removed the fixed cost, 25 minus 10. But I don't know the discount factor, but I want that NPV, which gives me my NPV equaling to 0. Okay, the one that gives you NPV equal to 0. So that, what does it imply? That my PV here should be what? 40,000. So that you get your 0 here. So if I get 40,000 divided by 15, I should be able to get the discount factor here. 40 divided by 15. What do you get? Two point
2.67.
667. So what does it imply? That you are going to go on your tables, the annuity tables, and look for the closest figure, which is this, and you see where it falls, 2.667. That would be our discount factor. When you check your tables, where does that one fall? Under what rate? Nobody was identified it?
I'm seeing 2.6730 under 6% in 3 years.
No, you look for 4 because the period is 4. Look for 2.667 in period 4. Under what rate does this? Does this one fall?
I have a 2.79.
Therefore, we shall consider.
Sorry, you go ahead.
It falls where?
Akaboy, go ahead. Mine skips from 16 to 20, so I cannot really give a better answer.
The closest is at 1%, 3.902.
No, you see, Akaboy, if you are checking, look in period 4. Look at period 4.
Yeah, that's where in period 4.
A period 4.
In the period 4, that's the closest. Using
your network is not. Eh?
Is it
I'm saying in
18%?
period
How about-
4.
Yes. I'm also thinking 18%. I have a 2.690. That's
18%.
Yes.
Because you look for the closest figure of 2.66.
Yes, it's the closest because the other one is 2.743 and 2.639.
Okay, so what does it imply for the discount rate conclusion? That if the discount factor, if the discount rate increases by 18%, okay, the project decision will change from accept to reject. Okay, the project decision will change from accept to reject. Should the discount rate increase by 18%, we shall have to reject. Actually, you can even do it and see if you evaluate this project at 18% and the other variables remain constant, they do not change, then that means that your decision is going to change from accept to reject. Now I see it is 10. There are some people going for another class. So once we meet next week, we should be able to wind up with this life of the project. Actually, you can do this, do life of the project, do part C, and do example number 2. Okay, because it is the same example. You do example 2, and then next week we should be able to finalize with the investment decision, and then we look at the last 2 decisions. Of course, that is dividend and financing. And I sent notes on dividend because I don't think I will take much time on financing decision. You should have looked at those theories. Okay, the different sources of finance, internal and external. Then you look at the capital structure. Okay, and then the capital structure theories. So please take some time and go through them, because actually the dividends and financing, they will be handled in only one lecture. That is probably in the coming 2 weeks. Then I'm also going to post notes on financial distress. I don't know whether I posted those notes, financial distress and corporate restructuring. Then also cost of capital. Do you have those notes?
No, we don't.
So I'm going to post notes on cost of capital, then also financial distress. Okay, but please, like as I said, the financing decision and dividend decision, I expect you to have gone through them. But once we meet, maybe we handle issues that are not clear, because majorly they are theoretical areas. There are no quantitative aspects. So once we meet, then we should be able to handle areas maybe that are not clear. Okay, so let's.
Caroline is asking a question. There's a question on the chat from Caroline.
Caroline is saying, why do we consider contribution as decrease, not as increase? Yeah, of course, the other one is an inflow. Because if you increase the inflows, you don't expect to have a negative NPV. But if your inflows reduce and then the costs you find are constant, that's when you'll find that your NPV will be negative. I don't know whether we are together, Caroline. The contribution is an inflow. If the inflow increases, the NPV will still be positive. Actually, you will get a larger positive NPV. But if the inflows reduce, and then you find that your cash out, the costs constant, then you will have a negative NPV. Are we together, Caroline?
I have a question also. If we could go back to that number we just did, the calculation.
Which one?
The very last number we've just been looking at, where we've tried to calculate the discount to come up with a conclusion on the discount.
This one.
The discount rate.
Yes.
So I'm wondering, this 40 that is from year 1 to 4 that we used to divide by 15, so we come up with 2.6667. Why do we have? Because I see initially year 1 it is 0, and then again we are using the same 40.
Yes, because we say that for us to get our break-even discount rate, because if we are looking at the sensitivity, the discount rate, then we need that discount factor that will give us an NPV that is equal to 0. So if my initial investment is 40,000, so ideally it means that even my PV of cash flows should be 40, but inflow. So if I get 40 plus 40, that will give me 0. But to arrive at that, of course, I have my contribution of 15. So if I get this 40 divided by 15, it would give me an approximate figure for the discount factor, which is 2.66. So meaning that that is the figure that you use to go on it, because you assume that you don't know the 18%. You don't know the 18. The discount factor you don't know. You want that break-even discount rate. If you go to your tables, that's why you look for the closest figure. Of course, because the life of the project is 4 years, the closest figure to 2.6667. And where it falls, it is the rate that you will use as your discount what? Factor.
I also have a question.
Yes.
Is it possible to share these notes where you are calculating? Because the notes we have do not have these working.
No, sometimes I don't. Maybe the recordings, because sometimes I don't save the. I don't normally save.
Now, like this one.
In fact, that's why the recordings.
Maybe the recordings, because sometimes I don't save the workings. If like you check in the previous, I don't think. The best thing is to share the recordings. Because in some cases I don't share, I don't normally save. But the recordings you can see. Once you let me, I'll take some time and upload all those recordings that we've been having. Probably by Wednesday next week. So all the recordings will be uploaded.
And so you'll be able to share the YouTube link.
Yes. I will upload
Thank you very much, sir.
I will upload them. Okay, so check for the notes on financial distress and notes on cost of capital. Because dividend and financing decision, you already have those ones. All right, bye-bye. But complete the number and even do illustration too.
But if you can share today's notes, at least for this part, I see you still have, so that we base on that. Some of us missed part of this because of network.
All right, let me send this.
Okay, thank you.
All right.